What goes up must come down. Following a healthy boost in sales in October, Fraser Valley home sales dropped in November as slower seasonal buying trends set in amid balanced market conditions. Jordan here, your Fraser Valley Realtor, and I've got your market update for December of 2024. So you'll recall last month I mentioned that despite the industry at large claiming it was rate drops driving the bump in sales we saw in October, I believed it was more likely to be a delayed fall push that would have otherwise have come in September. I also predicted that the market would slow again in November as the rate drops we saw didn't affect most buyers that were looking for fixed rate products, which hadn't really changed. That's exactly what we saw last month. All right, with the told you so out of the way, let's talk stats, and then I'll break down what I'm seeing in the wild. The Fraser Valley Real Estate Board recorded 1,136 sales in November, down 15% from October, but 28% above the November 2023 sales. A decline in new listings chipped away at overall inventory in November, with active listings declining 8% to 8,125. This is expected for this time of year. Everyone but the most motivated sellers are going to start hunkering down for the winter. Buyers take note, however, there won't be as many options, but those on the market want to sell, so keep an eye out for deals. Or, let me do it for you. Overall inventory, however, remains at a 10-year seasonal high and 30% above the November 2023 levels. New listings dropped 26% in November to 2,367, but remain above the 10-year seasonal average and above levels from November 2023. The Fraser Valley remains in balanced market with a sales to active ratio of 14% according to board stats. The market is considered to be balanced by the board when the ratio is between 12% and 20%. Bear in mind, it's balanced due to the bulk of detached markets being pretty deep in buyer's market territory, while attached townhomes and condos are faring better, pulling the average up. Maple Ridge detached, for instance, are seeing an 8% sell-through rate, while Maple Ridge townhomes are selling through a brisk 20%. If you're looking for more in-depth breakdowns by city and property type, check out the market area page at jkre.ca. Benchmark prices in the Fraser Valley dipped for the 8th straight month in November, with the composite benchmark price down 0.2% to $969,500. Taking a look at HPI activity by property type, we see that single-family detached fell to $1,482,600. That's down 0.4% compared to October and down 0.1% compared to November of last year. It took, on average, 43 days to sell a detached home, which is 9 days slower than last month. Townhomes rose to $835,100. That's up 0.3% compared to October of 2024, but down 0.2% compared to November of 2023. They took an average of 33 days to sell, which is 4 days slower than last month. And lastly, apartments fell to $536,100, down 1.3% compared to October and down 1.2% compared to November of 2023. They took an average of 36 days to sell, which is 4 days slower than last month. I was a little bit surprised to see condos fall so much month over month relative to detached and townhomes, and I'll be the first to admit I misjudged that one a little bit. I had thought we were pretty close to the bottom on that product type, but it seems like we've still got a little ways to go yet. I mean, realistically, we're talking about a 1% change, but it does add up over the long term. There's a Bank of Canada rate announcement scheduled for December 11th, so place your bets on whether or not variable rates will come down again. I'm a little bit split here. I'm hoping to see another quarter-point drop, but I wouldn't be shocked to see them hold, given the positive economic data that they found last month, and given that inflation is in their target range. I love how the author of this Better Dwelling article put it. Canada must have found some economic progress in an old winter coat. Don't worry, folks. We've got trained professionals in charge, and they aren't flying by the seat of their pants. Fixed rates are currently sitting in the 4 to 4.5 range, and 5-year bond yields have dropped and have leveled off a bit, currently sitting at 2.92% at time of recording, after having jumped from 2.75% all the way up to 3.2% last month. They'll need to fall another 25 basis points before we start to see rates fall to the mid-3s, but I'm hopeful we'll still get there by early 2025. I had a conversation with a mortgage broker colleague this morning, and he found it likely as well. We were discussing how the potential rate drop would improve one of our mutual clients' purchasing power. He made the comment that her buying power increases in line with every other buyer, but I countered that there's a lag in market response on this, and a proactive buyer can capitalize on falling rates if they're quicker to the punch than everyone else. Basically, if we can get all of our ducks in a row, we can secure something sooner while the market's still slow, and then benefit from the potentially lower rates at close, beating the rush. I'm still seeing strong activity on well-priced listings, and homes that are considered deals are selling as quickly as ever. We just had a successful sale on a detached listing of mine. We sold in 5 days for over 99% of list price. The home had some challenges as far as pending work that was required, so the seller decided to price the home slightly under the market value based on recent comparable sales. They had the choice of spending over $25,000 to improve the home to the condition required to sell in line with recent sold comparable homes, or to price it as a deal and let the buyer do the fix. They ended up going with the latter, and they were about $10,000 further ahead by selling the dream, as I like to call it. In other news, the new CMHC mortgage rules come into effect this month on the 16th. Of the myriad of changes, one of the biggest is the change increasing first-time home buyers' ability to amortize at 30 years rather than the previous limit of 25, essentially letting them purchase more expensive homes by drawing the debt out over a longer period of time, thus reducing their monthly payments and increasing the total interest they pay over the life of the loan. I've made my feelings on this pretty clear, and you can read them in the article I wrote that I'll post below. Basically, I feel that this isn't addressing the underlying issue that led us to the affordability crisis we're in the first place, which is supply and demand, while allowing one of the most vulnerable types of home buyers to further indebt themselves. Call me jaded, but I see this as purely for optics. But that's just my opinion, and I'd love to hear yours. Were you surprised to see condo prices fall that much in November? Do you think allowing first-time homebuyers to amortize over 30 years is in their best interest? Let me know. And as always, if you have any questions, all things Fraser Valley Real Estate, whether that's buying, selling, or investing, give me a call. Thanks.